right, guys, we are back for another episode on the BLD Financial Podcast. And in today's episode, we actually have the pleasure of having Bryan Bouchard on. Bryan, thanks for coming.
Happy to be here, guys.
Yeah, no,
Thank you.
it's exciting. Bryan and I have known each other a long time. We did a deal together back in the day before pre-mortgage agent Bryan.
That's right.
Bryan's been investing for a long time, commercial development, multifamily, residential. Was it previously, I think, a firefighter in a previous life. Takes life and does what he wants to do to get there. Bryan's a pretty inspirational guy. Really happy to have him on. Talk about what projects you got on the go. But before we get into that, tell the world who you are, what you do.
Well, this is post-mortgage agent Bryan now.
Oh, congratulations!
I decided to let that go this year. So I started in the real estate game back in 2009 in the small multifamily space. I did the old house hack strategy, also what I would call like the first phase of CMHC financing. This is back then, like you could buy investment properties at 5% down. In 2009, I was catching just the tail end of that golden opportunity there with CMHC, and the idea was to still use max leverage back then, right? 5% down. I didn't have a lot of capital. I was a construction worker trying to buy my first property.
Well, everything worked back then, like the income on the property services the debt. You were able to scale it. There was debt washing at that time. Like it was kind of the golden age of being able to scale.
Rents were good, purchase prices were low, right? So I got into the first property for $13,000 down, lived upstairs, rented the basement, and I was still in like a good cash flow position. Bought a few properties with 5 and 10% down. Like I said, you could buy even investments back then for 5%. Amortizations, I think, I was getting the tail end of the 40-year insured amortization there too.
They were just pumping it.
The easy times, right? Like those are the easy times to scale. Not to mention there was a 15-year bull run that was about to happen that I didn't see, right? But anyways, that's how I got started. Small multifamily space. At one point, I had, say, 4 properties, and I quit my job as a construction worker to go full-time playing poker, right? So that was a chapter of my life to be a pro poker player. My real estate career was at a standstill there as I was not earning any money on paper.
That's kind of cool, though. How long were you a poker player for?
That was like 2.5 years. Full time, like just pro poker, and the real estate investing was on pause. This was in my mid-20s. I was trying to become a firefighter at the time, so that next chapter of my life was firefighting full time. City of Toronto. Picked up the real estate again, and eventually got into the mid-sized multifamily space. And when I met you was around maybe 2020.
Yeah.
Doing that first commercial deal, mixed-use deal, and then did a couple of conversions, commercial to residential conversions. And then the idea always was to get into the brand new, nicer stuff. That was always the goal. It seemed far away for a long time, and then pivoted into the new developments just about 2 years ago.
Yeah, I know your growth, where you've come from, just starting with a duplex and then making your way into commercial and then conversions and then multifamily. There's a lot of steps or reasons why, people progress in that way, whether it's personal debt servicing, whether it's, scalability, your goals and stuff change. It really is impressive to watch from somebody who started with probably most people who are listening to the podcast. They want to get into it, but that 30-unit building or 20-unit building seems so far away, but it's not impossible.
I think that's it's a good reminder that it's not always just jump in, buy, a 30, 40 unit building and you're cashing from day one. And like there is a progress to it. Now, some people can kind of get away with getting in, maybe they have a bit more money on hand or, they have someone who can help partner up with them. But there is a bit of a progress to getting into real estate. If you want to do it a bit more safe and a little bit less like risk averse, right? Like getting into the house hacking, the duplexes, doing a refinance in a couple of years, like pulling that out. Like that is a very safe and effective way, obviously, as you've shown, to grow your rental portfolio without having to just jump into the trend of trying to build a 20-unit building and borrow all of your equity from everybody, and now you're leveraged out, right? Like there is safe, reasonable ways to do it that have proven success records.
And I'd say the main reason why I did it that safe, slower progress way is just because I didn't have the education and the mentors or the network to partner. There are faster ways to scale and even still staying pretty safe, but that's a very easy way to do it that anyone who's watching can do it. It's the house hack, and it still works. It
Yep.
still works. 5 or 10% down, live in one unit, rent the other 1 to 3 units, and then slowly grow from there.
I think hindsight's always 2020 though. You look back being like, oh, I would have just done this at the start. I would be so much further ahead. It's until you get here and you realize, you don't know what you don't know.
Yeah.
Kind of like business, life, all of it.
Yeah.
But looking back, anybody's listening to this podcast, like you can actually make it happen. Like you can go and do it. But there is expedited ways to do it. I'm not saying go spend $20,000 on a mentor, but go talk to somebody who's actually done it before. The school of the hard knocks is something that most people are now learning or have been learning for the last few years. There was a lot of people who got into investing and developing, bought their first few houses and retired and wanted market exposure, but forgot what other side of market exposure looks like. And the market's kind of working its way through right now. And it's interesting to go through as an investor and ride these different cycles. We saw ridiculously in a high increase in values, and we're seeing interest rates go up, go down, and markets correct. And you've been investing throughout the entire time, and you made a pivot not too long ago to get into like development, like real deal multifamily. I know I was watching one of your previous developments. It was you retrofitting, or you were redoing like a pre-existing building?
Yeah, so I guess that would be one of my conversion projects that I did. This was, before partners and before having investors. This was just a solo project. I bought a vacant commercial building, just like a 2-story single unit. It's been abandoned for a few years in Owen Sound, and the building had a bad reputation as well. But I converted that into 5 new residential units. That would be like my first development conversion type thing. And it ended up being like a great project, and brought it to CMHC. Got the long amortization, the big loan on it, pulled all my money out and then some, and it cash flows well. So that was the transition point, I think.
More difficult than you thought? Like when you took over that project, when you got into it, was it something that you're like, oh man, this is a lot more than I thought it was going to be?
Not work-wise, more expensive than I thought.
Yeah.
I blew through the budget. Timeline, timeline went 3 to 6 months over, and then the budget was just like 25% over.
Oh, wow.
And that was just because with these older buildings, when you open up the walls, you open up the floors, the floors they're never even. There's like all kinds of work you got to do just to get it to where it should be. Whereas a new development, you just build it the proper way from scratch, and it's cheaper. And you're correcting all these mistakes after you open up the walls and weird things that people have done in the past. So those are all just like unforeseen things. Whereas like a new development, the only thing you can't see is what's under the ground.
Yeah.
I think we get questions. I mean, I've had people ask like, why is development volume on like the newer to mid-sized investors so high? And I think you just touched on it, because it gets to a point where, and specifically probably more so in Ontario than Alberta or New Brunswick or something like that. But when you start getting into like these burrs or repositionings of apartment buildings, it's just gotten to the point now where the cost of doing it almost equates to the cost of just going and building a brand new project. And you don't have to worry about getting, your tenants out, cash for keying, deal with all the legal logistics of that, which can easily extend your project timelines, can easily overextend your budget, because tenants are becoming more aware now. There's groups out there, they have paralegals in these groups now telling them what their rights are, telling them what's going on. So, they're asking for more, or they're just finding ways to knock it out. And that's a big reason of it is it's just easier now to get in. You get to set your rents from day one. You have a bit more of a fixed idea of what your budget's actually going to be. Obviously, you can still go over, but it's a quicker process, and it's a little bit cheaper sometimes to be able to get in and get it done. And you have market rent set from day one, and you're good to go, and no rent control moving forwards.
Good point, because my next project right after that was a ground up development, and it was a great comparison. And prior to doing that, I just thought it was more expensive than it was to build brand new. And doing that full gut renovation is taking everything back from the framing and going forward. Like the only thing, I put a new roof, I put all new like soffits and exterior, new windows. Like what was I salvaging? It was basically
Bricks.
like the foundation and the bricks, right? And to me, it seemed like, knocking a house down and digging out a new foundation was a big thing, but I probably could have got more units. They would not be under rent control, and I'd have a more valuable building. But
I think it depends on the project, but it's all like you almost need to have more personal experience and knowledge going in and doing the like a gut job or reno reposition than you do going into like building ground up, obviously it's great to have, the experience in doing the ground up, but right from day one, like you're going to have your architectural drawings, you're going to have all these professionals putting this all together for you, where you don't have that same like overhaul of all of your documents from the team when you're buying a building and you're going in. You're going to get probably some quotes from a GC. Someone's going to go in and say, yeah, you're going to have to do this, you're going to have to do that, but you don't have the same like X-rayed vision of the project. And yeah, as soon as you get in there from day one, you start tearing things up. Like it's so hard to find those surprises ahead of time, unless you have that experience getting into these certain types of buildings, church conversions, old factory conversions, whatever it is. But it's a little bit easier, almost in my opinion, to do the new builds. From
exactly.
Very specifics.
So just use a bigger contingency for those renovation budgets.
Oh,
if you're
100%. Yeah.
double it or triple it.
Yeah,
like
probably a little bit more than 5% or 10% that most people get away with. So
Well, if you factor in like, the actual capital allocation to be able to take on a pre-existing building, even if it has vacancy in it, your good bridge debt, you're 25% down, 6-month IR, prepaid interest up front, and then all of the, the surprises behind the walls. By the time you factor it in, you're 25% that you need for a brand new construction on total project costs. You're probably the same,
Exactly.
even your financing options, like
Yeah.
in theory, like, on a construction project that would qualify loan size wise, like you get CMHC construction, you get high end or more bank financing, either credit unions or an actual bank. But a lot of conversion and repositioning projects, like you're in higher interest type debts. Obviously there's some that are pretty competitive, but you're not getting the same access to products on a conversion and a reposition as you are just doing brand new construction. Again, obviously some variables like depending, but you get better financing options technically right away.
Yeah, and I remember being cash strapped during that project because, like, again, I had no partners and I didn't have investors coming in, so it was just like, we're going over budget. It's 25% loan to value and on the improvements and everything like that, and it was getting tight during the project. I was like, I can't look at other ones. I can't grab more. I was focused on this one. So, yeah, I mean, there's pros and cons. It is a lot faster than doing the new development, so it was wrapped up quickly and less inspections and things like that, but
No permit process to go through zoning, like it's for the most part,
from that standpoint.
And we're seeing a lot of clients, opt to go that way, especially with like the CMHC 4+1s in the GTA. Like instead of fully demolishing the house, they're actually just like taking the top off and like building up and then back. It's I think we're going to continue to see it. You see increased densification laws. You see all these new city bylaws coming into effect. I believe they passed 6 units as of right, or they're trying to pass 6 units.
I think they did yesterday.
It's passed, yeah. You're like 6 stories on major streets now.
Yeah.
We're going to continue to see this increased densification, and a lot of the lenders are just now getting to understand this isn't just like a phase. You take a look at, you go to these big events and you hear these massive developers. Oh yeah, we're pencils down. We're not doing anything. We're not cutting any equity checks. It doesn't make sense for us to be able to build right now. But when you take a look at the mid-sized investor developer, the guys who are either doing it themselves or they're getting friends and family involved to be able to get this done, we've never seen so many projects move. Because they all work from a return on investment perspective. If it's your own capital, you can acquire the asset. You can get top tier financing. Obviously, assuming bond yields don't continue to increase, but we think this is going to continue to be a strategy. You invest not in GTA. You're where, Windsor?
Yeah, I love living in Toronto. I live here in the city. I have a hard time making the numbers make sense. But to your point there, like it's starting to shift a little bit with no DCs on the 6 plexes and stuff. Is that right? Toronto's starting to make it more appealing. Mississauga scrapped development charges, I think, on the 3-bedroom units and then reduced to 50% on the other ones. So they're starting to come around and become more appealing to me. I'd love to have more projects in my backyard for me to,
of course,
to visit, right? But to your question, no, primarily Windsor. Like we have 3 projects in Windsor, new developments, and that previous one was Owen Sound. I like the Niagara region. I don't have any developments there. I have property there, and we've also just gotten one tied up in Pembroke.
Oh, nice.
Outside of Ottawa there.
Pembroke is a really interesting market. I have a client who owns a pretty large building out that way, and the demand for rental housing is off the charts. Like the actual municipality is dying for decent rental housing. It's a very transient kind of area because they have they have a military base and people are coming and going, but people will pay top dollar for rent, but there just isn't anywhere to rent.
And that's like there's several tertiary markets in Ontario that have the same thing where the rents are very appealing. There's not enough rental housing, the demand is high, and it's the same type of scenario where the land is pretty cheap and it pencils out. And we like those municipalities. They're also very easy to work with. They're very flexible. They're easy to meet with. They will make some adjustments on, property taxes or development charges or things like that to incentivize the development. So they're better to work with than the large municipalities.
And it's almost more benefit, like, even if you compare overall like ROI and profit on some of these projects, like the ease of to be able to move through the process and get shovels in the ground without having the same pushback that you would get. I mean, if you can get in and get a project done in 12 to like 16 months versus you could be 12 to 16 months just waiting on permits and zoning discussions with some of these like major cities. One of the biggest costs of getting into these projects is just carrying the land. And if you have to carry the land for an extra year and a half when you could already be finished the project, like that just expediency to be able to move through, like it's forced ROI back into your pocket. And it also probably just like a better ROI on your mental health too. Like you're not absolutely banging your head against the wall trying to get these things through where you got everyone's talking about, we need more housing, we need more rental supply. And, but, no actions are really being pushed in that direction. Like it's just more enjoyable probably building in those areas too.
It's huge for me. And like one of my like main practices is like whenever the ball's in our court, let's be as quick as possible. And as a developer, you're dealing with so many different people and so many different conversations and applications and all this type of things going on. Whenever it's in ours, let's get it done as quickly as possible. Put it back on the city, put it back on the architect or the designer or the mortgage agent, whoever, right? And then when it's in their court, a municipality that takes 90 days to get back to you on something small, it's frustrating. It's like we have to be as quick as we can on our side and never let things slip. But then it's super beneficial and nice when the municipality is quick and your team is quick.
Well, time is money is a thing, and I think a lot of municipalities miss that. They take developers for granted, and they don't necessarily factor in that this person has a running daily burning cost on this land. And for the most part, the really successful developers, they try to acquire land in cash. Especially if you're going through rezoning or it's going to take a significant amount of time to get through that. If you can acquire in cash and get your soft costs in cash, you mitigate a lot of that, upfront additional costs you don't have to absorb, especially if you are going to have 25% of the total project costs already in anyways. But yeah, no, I think there's definitely a gap that is slowly being bridged. You have like Brad Bradford and, a few other people, at least municipally in Toronto, that are louder voices that are pushing for, faster permits being issued and whatnot. And the federal government, it seemed as though they were a little bit louder during the federal election about making things go a little bit faster. It's kind of quieted down a bit, but that funding requirement is still there. So like I believe they set parameters for permits being issued in a certain period of time, and municipalities get a certain amount of funding. So it's good that they're incentivizing these municipalities to actually push things through, because this missing middle development, what you're doing, what people are finding as doable deals right now, I think that's going to continue to trend out.
I think you have to have more officials that are open to actually building the relationships with the developers too. Like in the bigger city centers like Toronto, like you're not going to get, I mean, it's good to see guys like Brad that are willing to kind of be a bit more like public and relationship oriented, but you get in the smaller like towns, like, the mayors are more welcome to come out and build that relationship with you, have the conversations, come see your project, like to email you, phone calls, like stuff like that. Like if you can build that relationship and that official is more open to that, I mean, it's going to make the whole thing a lot easier as well too, versus, trying to get in touch with like, Olivia, like how many times is she calling back a developer or going out to visit a project and shaking hands and, hey, like tell me what you're actually building here. Like, how are you trying to benefit our city? Whereas, these smaller guys, like some of my like friends and guys that are building in Barrie, like they've built a really good relationship there with the officials there, and it makes their projects a lot easier. And it's going to help just with like the public facing as well too, because obviously that's a second piece of it. It's not just can you make all the numbers work and can you get the zoning, but you also have to get like the neighborhoods on your side as well too, just to be able to avoid any sort of like council pushbacks, right? So
yeah, I mean, it shows where the city's priorities are, and The big overarching shift, though, is the fact that we are moving in the right direction, and it's like finally starting to come to fruition here. It's like we've had this housing crisis for so long. It's been a topic of conversation for so long, but we're finally starting to see governments on all levels starting to make some changes to promote and make it easier to actually get shovels in the ground.
Yeah, I
It's
mean,
needed.
absolutely, it's needed. I think that there was, the left hand wasn't talking to the right hand for a long period of time, but now that's actually happening, which is, encouraging to see. That being said, the risks associated with becoming, a developer, obviously, we've had a few chats about, those goalposts moving, and part of the podcast here is discussing just the reality of what does it look like. It's great to from the outside looking in, Bryan's got it all together. He's doing these developments, or all these people are doing these things, but understanding what that actually means. We were talking before we started shooting live that CMHC as a product in general, you use it for your takeout financing, but do you use that? Do you CMHC construction debt, or are you using conventional construction debt right now for your projects?
We're doing CMHC construction debt, and there's a few reasons for that. One is just because we've seen so many changes from CMHC, and we want to lock it in. Two is we're still in growth mode, and we want to have a few projects underway. And we do underwrite conservatively, and we do a lot of self-performing on our construction, so it builds us a decent padded budget versus just outsourcing to a GC. So I think for those reasons, we go to CMHC on the construction. Now with the recent changes, higher premiums, it's like really starting to tilt things. It's getting close, in my opinion, on what the best path is. But when you weigh that out, I think CMHC on the takeout still makes sense for the long-term debt, just because of the rate discount that you're getting and the cash flow, right? Like, yes, maybe you're paying a 4 or 5% premium, but what's the discount on the rate versus conventional takeout debt? Like,
I guess it depends on loan size. It really, on a smaller loan, probably not a ton, especially in today's bond markets.
1%?
Yeah, well, maybe less.
Maybe less.
It's about
Depending.
1.5. Like I just had one quoted out by Equitable Bank. It's about like the building was like 1.9 million, and they were quoting back 6.5 for a 5-year and 6.65 for a 3-year. So that's like you could be rates on like a 1.3 million dollar loan size
On a 10-year term, on a $1.9 million
well,
loan.
I mean the CMHC comparable on that was. Well, CMHC is a little bit different, right? Because you're underwriting to your ceiling rate, right? So with the buy down, but the buy down was essentially bringing the interest rate to like a 4.35%. So you're almost like 2.5% higher on that with an extended amortization.
Yeah. So that's heavy. That's a big advantage, right? Like
It was like
even if you pay
$1,500 a month difference on the monthly payment.
But that's equitable, though. That's a B lender. You go to A lender, you're probably 5.5, not 6.5. On the rate. But yeah, probably like maybe 1.5 to 2%, depending on the project.
CMHC has that premium where the conventional doesn't, but you're getting a discount over a 5-year term. It's like saving 1 to 1.5% each year for five years. It's like you're going to get that premium back on the savings is the way they look at it. And I think if you're doing a project, whether it's construction to takeout or doing like a BRRRR project, and then you go to CMHC on the takeout and you maximize your leverage, I still think that's the best play because you get the cash back. Like you've already built in your profit. Either you're building at a profit or you've renovated at a profit, and you want to get access to that, as opposed to just like putting 100% financing on a new purchase and leveraging the whole thing. There's no profit in there. Whereas like if you take out the profit, at least you could put it in cash. Like it's yours to deal with it. I think the money's always better in our hands than locked in equity or whatever, right? Like you still can use it to pay a shortfall. It's just when you take it and then go to the next project, and there's nothing in reserves.
Velocity of capital.
That's
keeping it moving. Absolutely.
Especially for mid-sized investors where, every 100 grand is an extra 100 grand you have to borrow at, 10% from a prom note or something like that. It's a JV, right? So.
Yeah.
It when you take a look at the difference right now between conventional and insured loans, today's bond yields on like mid-sized to smaller size loans, it really is taking a look at you're paying just to access equity at the end of the day. And like I've had a conversation this week with a client just about we were looking at the difference between the two, and I think the difference was $600,000 or $700,000 on like a $4 million loan. But the cost to be able to get that additional capital was a $200,000 insurance premium to be able to do it. And he was asking himself the same question, like, is it worth it for me to spend, the money on the insurance premium, the broker, the lender, the legal costs to be able to put it together, to be able to access the capital? And I guess it really is up to you at the end of the day. Like, what can you do with return on that capital to keep it moving? But as we see bond yields, creep up, those questions are starting to become more difficult. Are you going to pay to access the equity it's stuck, or are you going to leave it and let it ride?
Exactly. There's a lot to consider. It's not one size fits all. There's a lot of extra line items there to consider. And the question at the end of the day is, what are you going to do with it? And what stage are you at? I mean, it's very common. I'm sure you guys see it all the time. The newer developers and investors just straight to CMHC, and then you probably see them transition slowly, get more equity in each of their buildings and go a little bit towards safety, right? It's growth mode versus preservation. And do they have investors in there? Right? Like, are you treating this as an investment or a business? Are you trying to get paid from it? Right? Like, we raise capital from investors. We bring investors in to invest passively. We don't need to go full max leverage on everything when we have that extra cash. And then everybody wins. We're going safer. We're removing some of these fees and line items, and there's just more profit at the end of the day to split, and you're in a safer position, even for like debt servicing standpoint.
Yeah, I think if your investment strategy involves paying people out, especially on construction projects where you don't get the same lift as you would through like a repositioning, like you have to understand that you're going to have to go on a higher leverage, and you're not going to get, like, there's not going to be money back into your pocket. And also just understanding the risk too, that like throughout a construction project, like you could be, depending on the size, like you could be anywhere from like 1.5 to 2 years. And during that time period, like you do have market exposure on the rate. There is potential that that loan doesn't come back quite where you want it to come back at. We're seeing some rents softening. So like you have to have some candid decisions and conversations with your investors too about, hey, look, like here's our target. Here's where you guys want to be paid back, either at the end of this or in 5 years, or you're on for the ride for 10 years. But here's our goal. But, realistically, there is some exposure here. And what happens if you don't hit your goal at the end? Like, what happens if you don't get paid out right away and that's your expectation? Are you okay to stay on for 5 years until we can do a refi or something like that? Like, those are the conversations you do have to have if you're going the CMHC route, because those are the risks that are like very present in today's market. Like, you may not get all your investors or capital back out of the end of their project. They may have to be there for 5 years, or at least a few years until you're in a position you can actually refinance your new development project and get a little bit more equity out.
I agree with that. And
because it's your reputation's on the line too, right? If you borrow $500,000 from some clients, from investors, and they're all expected to be paid back at the end of your project, and you don't have any other conversation, yep, we're gonna be good to go. CMHC that market shifts at the end of the day, which is outside of your control, and you're like, oh shit, you guys have to wait 3 years for us to be able to stabilize the rents, get some, get the value up, and then we can refinance and pay you out. Like, if you don't have that conversation ahead of time, like there's a really good chance that you've kind of ruined that relationship with your investors, and that's going to halt your progress pretty quickly as well.
that's key. One like way to run a good capital raising firm and development firm is to have stellar communication with your investors, and that's where a lot of large players go wrong. Is that there's no communication. There's no treating the investor like they're important. You know what I mean? And I've done many passive investments with like the large firms, and you just get like a quarterly update, and sometimes it's like, oh, by the way, like we just extended the project timeline by a year, and it's just written in this PDF that they attach to the email, right? Like,
and you're still lucky to be a part of our project.
Yeah, thank you for your sacrifice.
That's it. That's how they broke the news to you. Whereas like we would be available to get on a call and explain why, and we're going to update like way more often than quarterly. This is where your money is going. This is like what your money's actually doing, because I know what it's like. You want to know what's happening. It's not just, okay, the returns are coming in, sure, but your investors are probably interested in the project that you're doing. That's why they invested with you. They trust you and they like real estate. Yep. Otherwise, they just put it in an index fund.
Well, they invest in the vision, the vision of like, what you're building and how you're building it and being part of it. And, a lot of the people who are getting exposure to this, like they want to feel like they're part of, a deal. They'll tell their friends about it. They'll talk about it. It's, you're investing, you're one of like maybe 10 people, who are part of this project. You're not as you said, an index fund,
Exactly.
you're just throwing money into something.
Yeah. Yeah, it's something to be proud of. And people like to talk about their investments. And if someone asks you where you're investing your money, you're saying it's in real estate, and then they ask you more about it, you're like, yeah, I mean, I don't know. I invested the money with Brian, but we don't know what they're doing. You know,
Yeah.
I haven't heard anything in a long
I
time.
think they
Like,
dug a foundation.
Project was
I don't
supposed to be
know.
finished a year ago. We're not even close.
Yeah.
Like,
I want them to say, yeah, like there's updates all the time. We see them on social media with their building, and
Yeah.
they send us updates more often than they need to, and we can get on calls with them personally. Like
and it's great
I think
marketing
that
for
goes a long
you
way.
too. Like if, usually obviously the guys you're dealing with are higher net worth individuals, and they're going to have friends in their circle that are higher net worth individuals. And, they're sitting down, like shooting the shit, and, oh yeah, look at this building. Like I'm invested in, it's a 40 unit building. Or it's a 50 unit building. Like, look at the progress. Like we're on pace, but this is my returns. That guy's friends probably like, oh, hey, like how do I get involved? Like it's almost free marketing for you to just keep those relationships on a healthy point. Like,
In any business, just doing quality service, and people are going to talk about it. They're going to be proud of like the success that they've had with any purchase or any investment or any service they received. They're going to tell people about it, right? And I think just to your point before about like different strategies and pivoting, I think I like to avoid tunnel vision and just having one strategy and all that stuff. My strength is more on the strategic side, higher level, zooming out, taking a complex problem. How else can we do this? How do we pivot if we need to? And then actually making the call when you need to do that pivot. And I think people underestimate building to sell. Like, building to hold is what everyone wants, the long-term investment, CMHC, high leverage, but a couple of build to sells to generate revenue, and then a build to hold, like balancing that out. You don't have to hold everything, but holding is always an option, of course. Maybe selling, if the market shifts, you can't sell it. You still want to hold that multifamily or whatever you're building, but the selling will generate revenue so that you can have more safety, more liquidity, a bigger cushion to take bigger buy and build to hold projects.
Success isn't linear, like you don't have to just do one thing to be able to continue to move forward. We're seeing a lot of people pivot. Obviously understanding that what the appetite is in the market to acquire one of those things and like building it to spec. You're uniquely positioned as a developer. You understand the debt side of things. You understand the construction side of things. Very few, even high level developers really understand the debt side. I think that is kind of the key here because the money is at the end of the day the most important aspect of your project. You bring that insight into understanding like a deep knowledge of the debt structure, and I think that's a piece that as like the secret sauce to continue to move your projects forward that most developers don't have. You did a little bit of construction, commercial debt before you got out of becoming a mortgage agent. I assume you're taking that with you, and you structure your own deals when you're putting that together.
Yeah, the actual like mortgage agent servicing side of things is something I had to let go because I needed to be more focused on what I was doing, and it was just this year was more about just cleaning up distractions in my life, personally and professionally, and that was one of them. It's like, okay, but to your point, like, yeah, the knowledge is very important, and that's still with me to apply to our deals and to look from a different angle. I mean, it's just catching small things in our pro formas and stuff like that before we finalize it. It just happened. It just happened like last week where we could make an adjustment to the ceiling rate where the lender wasn't looking at that and he's like, this is what CMHC came back with, and we adjusted the ceiling rate because it was too high. It was like 4.5. I'm like, can we get this down to 4.25? And it just resulted in a few $100,000 to the loan for just catching that tweak that he didn't, right? Like, that's just from the mortgage agent experience and stuff like that, and then just even structuring deals, capital stack, raising private money, and all of it.
And that's a great testament to why you work with someone in the mortgage field, like mortgage broker, mortgage agent, whatever. Like you and we like have that mindset to look at it where, we work with a lot of great lenders, but the lenders are always looking at it from a slightly different mindset. Like they're not there to always pick through the little nitty gritty things that are going to be best, like top of mind things for the client. Some of them are really good at it. Some of them, it's just not that thought of mind. But from our perspective and your previous perspective, it's, hey, like you're looking at it from this perspective, like we're down here. Like, can we make this switch? Oh yeah, this is just where the number was. I thought that's what we're moving ahead with. No, let's make that tweak. CMHC, like you can go back and request lower ceilings if there is room. Like it is things that you can do in these little kind of pieces that, sometimes do result in a couple hundred extra $1,000 back in your pocket. And that's a huge win, right? Yeah. So it's having working with someone that has that perspective from the client first. And again, like there are lenders that you can go directly to, but the difference in terms of that lender's mindset versus, working with a broker that's there to build that relationship and is picking through all the things the lender's not necessarily looking at. And we're, kind of pushing back the lender, like, why are we submitting here when this is where we sent it to you guys at? What's the reasoning? Like, let us know and try to work with that. Like, there is a big difference in the mindset between working directly with the lender and having a broker that's there to fight for you and is quite literally only there to be on your side.
Yeah, no doubt. Because if you catch that little nuance later and say, "Oh, we could have changed that," like after you learn it or whatever, it's too late. And
It's salty because it's a few $100,000.
Yeah.
It's what you're, that's the margin of what you're looking for. That moves the projects along.
Yeah, and I think as a developer or an investor, whatever skill set that you have, it's nice to have an additional skill set. It might be on the construction side or something too, right? Like for developments, it's the developer, the architect, and the GC. Those are the three big roles to get the development off the ground. And if you're going to just specialize in one of those, then it's getting very good at the development side, the creative side, the visionary. What are we going to do with the land? Like you're playing with land. If you have the construction background, the GC side, that's really important too. A lot of budgets can get blown through just through having the wrong construction team. And then the design is the third piece. Like the design can really increase budgets just by poorly designing it from the beginning. The GC is just going to follow the plans that you created before, right? So just getting more into like this value engineering and getting costs as low as possible from the design standpoint, and then carrying that forward on the construction side as well.
I had a client, sorry, just to go off your design, like we went and looked at some of these developments in Edmonton, and we met with the one builder, and he was kind of going through a project where he had it previously up for sale and whatever, but the big issue why they didn't move through the development previously was like they put it all together, then the design, he's like, it made no sense when we went to go look at it at the end of the day. He goes, like the designer, they wanted to have like a unique feeling and design to like each floor, and he goes, when we looked at it, he goes, nothing lined up. Elevators, he goes, like the shafts weren't even like lining up on like certain floors, and unfortunately to like the developers kind of discredit, like they didn't even catch it until they were like quite a way into the development. But same thing, right? And I mean, it goes even a step further to, just because you can get SPA or just because you can get these approvals and zoning doesn't mean your project is financially viable as well too, right? Like SPA does not equal like affordable viability. Like it's two completely different things. And the same thing, like you could have a really cool building design, it may not work. Like the more boring design might be the best way to build your building from both just like a time and money point, right? So just because one thing works doesn't mean it's going to be an equivalent amount of like a viability throughout the rest of the project, whether it's affordability, whether it's zoning, whether it's SPA, whether it's design, whatever it is. Like they do all have to match up, and it means on some of your projects you may not get the dream project because something just doesn't match, but eventually you're going to get it. But yeah, everything has got to be in line moving forwards.
And there's so much to dive into that concept because like there's so many different design components and so many different construction methods and options and features. And it comes down to where you're building this, and you want to build a product that's going to fit in with the community. And it's not all the same. Like some fancy Toronto designed building is not going to be something you just repeat and take the plans and go to. Small town, 8,000 population. You have to just build what's needed there, and the cost to build is going to vary dramatically based on what you're designing.
Even just between purpose built and to sell, like the way you're going to build it is going to be completely different as well too. Who you're marketing to.
There's so many different hats you have to wear, and like people you need to trust, because obviously you can't be an expert, architect and an expert mortgage broker and an expert builder. You need to have those people around you to be able to have a successful project. And obviously, it takes time to be able to get those people around you and really to dial in that project, to create a product that's going to, as you said, be absorbed in the market and do it properly and have the people around you. It's not as easy as just jumping in and doing this. We're seeing a lot of people, even with this mid-sized stuff, become, duplex, triplex, fourplex, mid-sized market investors, move into, I'm going to become a developer now because I don't need to personally qualify for the debt. There's a lot that can go wrong, whether it's understanding the debt or the people around you to be able to make it happen. So, if anyone's listening to this, it's really important just to focus on, working with people who actually have done this before, a track record. If you're investing, a track record of people who have done the projects, who know what they're doing, who understand the area. Don't be the guinea pig on the first one.
Yeah, and it's been such a learning experience for me in the past couple of years too, because there's just so many more moving parts and people involved with the development than you may have thought. And it's about understanding your skill set as well as like your personality, what you're good at and where your strengths are, and applying that and like having designated roles. Like you're probably going to have a team. Maybe you want to do everything by yourself, but if you have a team, it's dividing the roles into what you're best at and getting the most output from like what you've actually had experience with and what your skills are. And it's been a good experience for me to understand like exactly where my experience is, where I'm good, and where I should focus my time on the development side. And yeah, there's so much to know, and you can't be good at everything, but you have to bring in the professionals in their like respective strengths and bring them in. You're going to have a big team, and it's going to be a lot of responsibility, but it's about navigating through that and knowing where you should be spending your time.
Yes. Development more so than other projects too. Like you really have to go through a project to like fully understand it, right? Like what is it like to manage your money? What is it like to manage the timelines on the actual build? Like you're always going to have hiccups. It's never going to be as fast. It's never going to be as cheap. What's it like to your tranches, right? Like which type of lender you're going with, CMHC, bank, non-insured, or whether you're going private. What's the difference between my tranche timelines? Like, is my builder requiring deposits up front, or is he willing to like move forward and wait, understanding that the tranches are coming? Because, if they're wanting deposits, like, again, that's more money that's going to have to come out of your pocket that you may not be accounting for because, well, I've already hit my, 10% down, or I've already hit my, whatever your minimum equity requirement is, right? Like, so, I mean, there's just so many things that you really do need to go through and just have that experience. And it's kind of what I always tell like the first time guys is you sit down, you go through the numbers with them, you tell them, okay, well, you're going to get a tranche here, you're going to get a tranche there. This is the minimum equity that you're going to have in, but they don't realize that like, okay, your minimum equity might be 10%, but that doesn't mean you're not going to spend more than that ahead of time getting to the actual stage of getting funding. Cause you got to buy buy the property, and ideally you're buying it cash or sub 50% just to keep some equity in there, and then plus all your soft costs. And if you're building with CMHC, well, they're not going to cover the demolition, so you got to cover the demolition of it as well too. And
10% holdback. You got your HST,
holdback, your GST, HST. Like it adds up so quickly, and it's not just as simple as, oh, I'm 95% cost, and I only have to have 5%, because you're definitely out of pocket going to be more than 5% before you're funding.
Totally. Yeah, it's about setting the expectations, and that's your guys' job right from the beginning, right?
Try your best.
And what about like the bonding requirement and the difference from needing that and not needing that? Yeah. How much of an expense on the pro forma does that make if you do need it or don't? Mm-hmm. What is it, a couple % of the construction cost?
Of being bondable? Yeah. It increases significantly. So like if you're looking to make that jump, from like mid-sized market development to like larger stuff, and your GC needs to be bondable.
Yeah.
It adds a ton of cost, and if you didn't factor that in, maybe you're looking at different type of debt. You got to factor in: do I take a little bit more expensive debt or conventional debt without having to be bondable, versus going and using CMHC and having to go through the hoops of it all? I'm assuming you had to.
No, but well, I mean, there's been a couple of pro formas where we would like jumping from our developments, which we have a 9, a 12, and an 18, and then jumping into a 60. Okay, well, who's going to be building this, right?
Yeah.
Like, and that's
have you built it before?
Yeah, exactly. Yeah. And that's the key. If you're going to be a brand new developer doing your first project, maybe you can handle something, but have you done anything? Who's actually going to build it, right? My first couple partnered with a builder who has built something similar, so they waived that. And
it's the very first question that all of our lenders ask us. Size and scope. Have they built it before? Has it been ground up? What's the largest project they built, and when was the last time they did it? And second question is how much money you got. It's the liquidity and experience are the two main variables, and you can't really do one without the other. Like you can buy experience. So if you guys are looking to get into development, you don't have it, you can purchase it. Make sure you keep, obviously, try to absorb as much as you can from the people who are going to build it for you. But you can't just jump into a larger development. A lender's not going to take on the risk.
It needs to stop being looked at as like a minimum equity. Like what's my minimum equity? Like, how many times you get a client where they call, I want to build, like, what's the minimum amount of money? I'm like, well, like, what do you want your chance of success to be, 0 or 100%? Like, minimum amount showing, you're probably going to be 0%. But if you can show, like, $1 million in equity, yeah, you're probably going to get your project done. Like, just showing up with the minimum and it's all in a line of credit, like, I'm sorry, but like the chances are the lender's just not going to have faith that you have enough capital to get this done. Like,
Don't be a minimum investor. Be
Yeah.
a maximum
And I mean,
investor.
you're seeing CMHC crack down on certain things every year, and for good reason, right? They're seeing all these applications come in. They are seeing patterns. They're seeing which projects are failing, which ones have the most success, and they're just gathering data, right? But I think like this is a good sweet spot opportunity where the doors are kind of opening for development across the country, and more particularly the provinces that have been so restrictive, like Ontario. So it's getting easier. The demand is there. It seems like a golden opportunity for the next decade or so. I think the construction's going to boom. There's going to be a lot of purpose-built rentals going up, and developers are just going to be creative. Like that's what they do, is they're going to pivot around the rules. No matter what changes, they're going to find a way to do it. And like you were saying, like if the construction cost is too high, then they start just taking the roof off and building up and salvaging the first couple floors or whatever it is, like they're doing here in Toronto.
They'll always find a way.
They always find a way.
Resourceful.
That's
the most
it.
resourceful.
Yeah, you got to be creative. You got to play within the rules that they give us, and find a loophole, or pivot into something that does make sense.
Yeah, and I think that's that's a great thing to leave off on. Bryan, appreciate you taking the time to obviously chat today. It was a great chat. If people want to reach you, if they want to talk about your projects, they want to talk about maybe investing in your projects, they want to talk about what you're doing, how would somebody go about contacting you?
Me personally, Bryan the Investor is how you can find me. Bryan the Investor, Bryan with a Y, or the company is Passive Investing Canada. That's our private equity real estate firm that gets investors involved in our projects as debt or as equity. You can join and be an owner in the projects that we're doing.
Cool, right on. Well, guys, we'll put the contact information, all the good stuff down below for everybody to see it in the description. Bryan, really appreciate you coming on.
Thank you, guys.